These three tax surprises quietly destroy your retirement income. The first is how large RMDs can become later in retirement. When too much money stays in IRAs and 401ks, it keeps growing for decades. Then once RMDs begin, that can mean tens or hundreds of thousands of dollars in taxable income every year, whether you actually need the money or not. At age 73, the initial RMD factor is roughly 3.65%. By age 85, it rises to over 6%. And by age 95, it exceeds 10%. And unfortunately, there's no mechanism to reduce RMDs once they begin unless the underlying account balance is reduced. That means decisions made in your 50s and early 60s directly determine the size of forced income in your 70s and beyond. If no action is taken during that window, your options are limited once RMDs begin. And this leads us to the second surprise, which is rising Medicare premiums due to IRMA. They're calculated using income from 2 years prior. So once RMDs begin, your Medicare premiums can increase by thousands of dollars per year. And these increases aren't small adjustments. Crossing certain income thresholds can cause a full step up in premiums that applies to both you and your spouse if you're married. And because IRMA works as a cliff, even a small increase in income can trigger higher premiums that applies to the entire year, not just the amount above that limit. And since it's based on modified adjusted gross income, multiple sources like withdrawals, capital gains, and dividends can combine to push you over a threshold, with the impact lasting multiple years due to the 2-year look back. And that means a single high income year doesn't just affect that year. It carries forward into future Medicare costs, even if the income later declines. And once a higher premium tier is triggered, there's no partial relief within that year. The full increase applies regardless of how narrowly the threshold was crossed. For example, in 2026, a married couple moving from just under $218,000 of income to just over that level can see Medicare Part B and D premiums increase by several $1,000s annually. And while these thresholds are indexed, they're not always in a way that keeps pace with portfolio-driven income increases, especially when large distributions begin. And because the calculation resets each year based on income, consistent withdrawals can keep premiums elevated indefinitely rather than creating just a one-time increase. And as income continues to rise from those same withdrawals, there's a third surprise that begins to show up, which is the Social Security tax torpedo. As income rises, more of your Social Security benefits become taxable. The calculation is based on what's called provisional income, which includes half of your Social Security benefits plus other income sources. Once certain thresholds are crossed, up to 85% of your Social Security benefit becomes taxable. And I've seen relatively small withdrawals taxed at over 40% because of how this works. And the reason this happens is that each additional dollar can cause more of your Social Security benefit to become taxable at the same time. So it's not just the withdrawal that's being taxed, it's also pulling additional income into the tax calculation, which creates a compounding effect where the true tax rate is higher than it appears on the surface. And because the thresholds for this calculation are fixed and not adjusted for inflation, more retirees are affected over time as income levels naturally rise. In fact, the provisional income thresholds have remained at $32,000 and $44,000 for married couples since they were introduced, with no inflation adjustment. So even moderate increases in income can trigger disproportionately higher taxes than expected, and each additional dollar can have an outsized impact on total taxable income. And this all happens gradually beneath the surface. And that means over time, a larger percentage of retirees fall into the range where 50% to 85% of benefits become taxable, even if their real purchasing power hasn't meaningfully increased. So now you have larger withdrawals, higher Medicare premiums, and more of your Social Security being taxed all at the same time. And because all three are tied to income, they stack on top of each other. And a single decision can increase taxes, healthcare costs, and reduce net income simultaneously. Once these effects begin, they tend to compound year after year since higher income sets a new baseline. RMDs continue, Medicare premiums adjust with a 2-year delay, and Social Security remains more heavily taxed as long as income stays elevated. So the system really just reinforces itself, where higher income today increases required income and costs in future years. And in addition to all of this, Higher taxable income can also affect other areas, such as the taxation of capital gains and eligibility for certain deductions or credits that phase out at higher income levels. And this creates additional indirect effects where the total tax impact extends beyond just the withdrawal itself. So what do you do about all this? One way to manage this is to recognize income earlier when tax rates are lower, so you're not forced into higher income down the line. That might involve gradually reducing pre-tax accounts before RMDs begin, rather than allowing them to build unchecked. Doing this changes the trajectory of the account balance, which directly reduces the size of future required withdrawals. In some cases, that can mean using a mix of taxable, tax-deferred, and tax-free accounts to manage how much income shows up on your return each year. So instead of income being dictated by required distributions, it becomes something that can be adjusted year by year. This creates flexibility later in retirement and allows for more precise planning around tax brackets and Medicare thresholds. It also gives you the ability to respond to changes in tax law or personal circumstances without being locked into a fixed income structure, and it also facilitates coordination with other planning decisions like the timing of Social Security benefits, when to realize capital gains, or funding large expenses without triggering unintended consequences. By controlling when income is recognized, you can smooth out taxable income over time rather than allowing it to spike in the later years. Because you'll never fully eliminate taxes, but you can avoid being pushed into higher and less predictable tax situations later on in retirement. You can maintain control of your income so that these decisions remain intentional rather than reactive. So those are the 3 surprises that can quietly destroy retirement income. And if you want to keep learning, check out this video right here.